Welcome everybody to the Wrkr quarterly update. I'm Trent Lund, your CEO, and with me is Gilmour, our CFO. Delighted to have the opportunity to just run through where the business is at. We've kept this presentation relatively light today. Obviously, we have half-year results that are not too far away, coming out at the just after the end of the month or towards the end of the month. So we'll do a much more thorough presentation. I thought we'd use today, give you a quick update, talk through some of the key elements of the quarterly, and really make sure there's time for open Q&A at the back end. So without further ado, always like to remind everybody what we're about. Which is revolutionising workforce compliance. So that is bringing our technology skills to bear on an industry from pay, super, and onboarding and ongoing compliance of employees, really to bear to make compliance simple. That's really the core premise of this business, is making those simple, small transactions as seamless and digitized as possible, because the on-flow effect of errors in data, hours of effort in contact centers and the like, so ripples of costs, lost interest, lost income for employee super, in fact. So that's really the core of who our business is. And obviously, our core strategy remains consistent and very clear. We have three phases of the business that we are pushing through. We work on all three simultaneously, but the bulk of our effort is really in the grow the base. We'll talk a bit about that today, some of the contracts that have come in and how they really have set up the platform for that growth. So reach as many employees in the Australian market, grow that value by delivering more and more compliance moments to those employees, which we continue to invest in parallel, and then use that base to create new sources of value. So I probably wanted to kick off with the key highlights of the business and just talk for a little while on some of those contracts. So obviously we announced the REST pilot. There have been some great questions from shareholders that we've answered on the hub, but just gives the importance of this. So obviously, first of all, this is a contract through Link with REST. So this is the first super fund user of the Wrkr platform using the Link build. So there's been a significant co-investment by Link and Wrkr to build out the Link build. So that by that, if I just give you some highlights and examples, very tight two-way integration to the Link Aspire administration platform. That is a substantive investment by both parties, and that is to ensure that our platform is really the front end for receiving all contributions, and actually the front end for receiving new members from employers, so employees being put into the platform. REST is a very significant first client of this platform, significant for a couple of reasons. One, REST is undergoing significant transformation as an organisation around their experience and what they're providing. They are quite forward-looking, so we're very excited for them to be the lead or anchor tenant in the platform. Secondly, the size of their current base is significant, about approximately just short of 2 million members, but about 1.4 million active employees. And they're in a very significant sector, being predominantly retail, but they do branch across many industry sectors now. But retail have what we call high-frequency turnover and high-frequency payers. So that are employees that are paid either weekly or fortnightly, and employees in an industry where there's up to and higher than 20-25% turnover. That means lots of onboarding moments. That means lots of transactions. And obviously, from a super perspective, as we move into payday super, that is significant for our business to be concentrated around those high volume customers. So where are we at? We are midway through setting up for the pilot. All of the core early adopter customers have been identified. What do we mean by pilot? So we are implementing the full build, which is the full contributions flow, which will pick up all the transactions. The area we are focusing on the pilot is the rollout of our branded onboarding experience. So that is where a retailer will be able to trigger a mobile branded event, branded for the retailer, to any new joiner and take them through a fully digital process of onboarding them, making sure that their details are correct, bank, tax, super, and passing that information back to the employer and storing it for accurate superannuation contributions payments. In addition, it includes our full build of the Wrkr One platform, which means we're not just able to provide super, we will do that under contract through Link, but we will also have the ability to provide direct in collaboration with REST, full pay, extended onboarding features, and then bring new products to market over time. So this is quite substantive. Core to the pilot is a portion of the piloting is the tech, but our tech is already in production, in market, across elements of the art platform and also with direct customers. So less from our perspective about piloting and testing the tech, far more about piloting the rollout and go-to-market approach to make sure that all of the comms are done seamlessly, that the experience is done seamlessly for those key employer groups of REST. So that absolutely critical first step. This is really the first client, and we expect to be the first of a handful of large super funds, which really I'll talk about towards the back end, but that holds all of our concentration right now, because this is the long-term bread and butter of our business. And with payday super, it's also a high growth engine for the business. So for now, this is the most valuable contribution that we're setting ourselves up for shareholders. Secondly, Link contract to license in the Wrkr platform and deploy that as a SaaS-based platform again into Hong Kong. This is incredibly significant for a couple of reasons. One, it is the same core platform as the Australian build. So that means from a technology perspective, we are not building, supporting, maintaining multiple platforms. We are able to deploy the same core platform into Hong Kong and into Australia for the Australian market. Hong Kong has meant we are adding additional features to the platform that are not currently used in superannuation in Australia, but actually have some good proxies for some of our wealth markets in Australia. And that is because the Hong Kong pension funds, the ORSO funds, are done as an employer branded pension for their employees, provided by HSBC in this case. So we will increase our features, but to the one core platform. So that means our tech deployed in multiple countries. Why are we excited? Obviously, it talks to the strength of the Link relationship. Having chosen the platform within Australia, made significant investment, and now choosing it for the Hong Kong market obviously sets us up as a key global partner for Link, particularly dealing with that front-end experience of bringing employees into a member, into a fund, and employers interfacing with the fund in paying their contributions and ensuring that employees are added on and added off as they change their employee status. It's a 3-year contract initially. One thing I would say, all of our contracts have taken a standard 3-year as we go through the first build phase. Obviously, there's significant upfront capital cost from Link. We expect these to be extended, and as you would have seen in Hong Kong, Link signed a 10-year contract with HSBC, so the durations for our contracts we believe will extend. But we're not focused on that right now. We focus on delivering an exceptional job and let the extensions follow. Obviously, from our perspective, this is why we've put so much intensity into Link. We have ongoing sales funnel with a range of other funds introduced to us by Link, and they are at different stages. Right now, we are at full capacity delivering on these two major programs, as well as our ongoing build work with ART, which is annually contracts at around about the same size. So that's the key highlights for the business. It's taken a long while, probably underestimated somewhat how long the decision cycle is when you add a super fund and Link. There's a lot of conservatism. They are making decisions for the long term. There are lots of boxes to be ticked, and we have definitely invested heavily in time and energy from a management team to get ourselves through this stage. We're really excited because we're builders by nature. Now we're in the true build phase, which is the precursor to all of those contribution income streams. So that is the core of where we've been at, and no doubt there'll be Q&A I can get to at the end. So over to you, Karen, if you just want to talk through the financial highlights.
Thanks, Trent. And as Trent previously mentioned, we're currently in the middle of the audit, which is always fun times. But we will have a full brief on the financials once we've submitted those reports at the end of the month. So I wanted to keep things relatively brief today for everybody. So good news is that we're up when we compare ourselves to the prior year half year. We're up on revenues by 44%. So that's really great to see that continual revenue growth that we have all been working very hard to achieve. Our cash receipts from customers is obviously followed in that footpath and is up. Unfortunately, for our net operating cash flows for the quarter, we didn't receive quite a material payment from a customer that was due in the quarter of $770,000. Good news is that's been paid now, but unfortunately that just kind of didn't meet our expectations of where we'd end for the half year. The cost to income ratio, we're still seeing a good kind of decrease there, an improvement in our cost to income ratio. But if I just go back to revenues, that growth has really been driven by quite a number of different avenues. Obviously, the Link detailed planning and now the start of the development and deployment has generated some revenues for us in this half year. We've also had an increase in our platform as a service as we continue to provide innovative solutions for Australian Retirement Trust's platform Beam. So that's been great for the business as we kind of grow and learn and innovate through that process. The SMSF Hub is continuing to grow and consistent growth, which has just been great to see. And we continue to be out there talking to the SMSF administrators about what they need and want to see in the product as we look to develop that further going forward. And then float, we've been fortunate enough to see the float income increase to that comparable period last year. So I've seen the inflation rates this morning, that's easing. So we will see what that does to the rates moving forward. But as we've kind of said before, it's a bonus for our business. We don't pin ourselves around it, but I think we'll kind of be seeing that stabilized interest and float income into the next 6 months. So if I move on to the next slide, please, Trent.
Gotcha.
So yeah, as Trent kind of said, the next 6 months is looking busy. We've got a lot to deliver on, and we've positioned ourselves really well to do that because of the investments that we've been talking to you all about in our investment community, over the past 12 to 24 months, to be able to execute on that quite quickly now and deliver a lot of that work in the next 6 months. So the teams are well prepared. There's been a lot of planning happening, and now they're just excited to execute on that. So there's a big buzz around the business, and I think we're all excited to see it out there in the market when it gets to that point. If I just talk about kind of, we're not looking to achieve a positive EBITDA in this financial year, as we've alluded to. That position hasn't changed, but we are still focused on achieving that positive EBITDA in financial year 25 at this point. So closely watching our costs, closely seeing how these implementations and deployments will happen and how quickly we can get the transactional revenues flowing post that deployment. And we've got a lot of focus around that go-to-market strategy and making sure that we can do that as quickly as possible so we can ramp that up and find the efficiencies from moving into that transactional phase out of the development phase. And then I will pass back on to Trent.
Thanks, Karen. So look, two elements of that. I just want to touch on. You will definitely see within our income, although we have been fairly diligent in building out products such as SMSF Hub. We obviously have the float income, which has been relatively high trading through last year and then fairly consistently this year. They help to smoothen out the revenue. Our contracts with art are relatively well geared, so we have good visibility of the income, but they are a portion of license and ongoing services. So as we continue to invest and co-innovate on that platform, but particularly around the larger link contracts, they do bring a lumpiness to our revenue. And there was a question asked in the Q&A, so just to touch on that, we have a strategy which is we have been very, very cautious on cost. I would, our CTO would love another 7 engineers. We'd love to spend more money and scale up. Our head of growth would like a large sales team, and all of that will happen. But we've ensured that it doesn't happen early in this business because we wanted to get ourselves show that we could manage our costs wisely. We wanted to make sure that we were bringing in new client contracts, so we had, before we bring on any real costs, we have real certainty of long-term revenue. By doing that, it's a double-edged sword. The negative side is we are putting large costs in front of the decisions of key partners like Link. So they are having to invest heavily in things like the integration to the Aspire platform. Rather than us make that integration and just make it part of our core product and hope to then grow into the market, we wait to win the contracts first and we share the cost of that work. That does increase the decision cycle time, but it decreases our investment requirements and it's more sensible for the cycle of where the business is at. So I just wanted people to understand that. I think what I would signal for you is now that that fundamental investment is done and baked in, we will look at opportunities to accelerate revenue differently. Now that we're in the middle of Hong Kong, we're in the middle of REST, there are a couple of other funds showing interest. We will want to bring them forward rather than spend a year of piloting and developing after these projects finished to then bring on their contributions. The sooner we complete the development cycles, the faster we bring on contributions revenue, which we see as a very lucrative part of the business. So signaling there'll be some decision changes as those opportunities and as we get closer to finalising on contracts in that space. So yes, lumpiness today because all of the front-end delivery of these contracts is geared around milestones. So we get to a testing approval, that releases cash. We complete the API integration, that releases cash. So this year, very much geared around that. First quarter of next year, we have some similar milestones. Post that, it starts to be more stable on contributions. So anyway, I just want to give that background. So it's a balanced investment. Short-term revenue generation matters, but we don't want to say no or go slow on long-term growth. We want to be more aggressive now because we feel that we've proven ourselves and validated our infrastructure and solutions into the market. Other work that's been going on, obviously, concluding our designs for product improvements around Payday Super and the single touch payroll integration reporting. These are not product fixes. These are actually geared around positioning our product. So as we move to Payday Super and Pay, which is already done, let's say, fortnightly, and Super, which is done quarterly, the moment you're bringing those two items together, we are ensuring we are feature rich enough that we're the logical choice to extend from the Super payments up in and have us manage your pay process and manage your single touch payroll report. That's how we'll increase our average revenue per customer on top of the large base that we've been signalling. And obviously I touched on it, but we see a continuation of the development projects with art, you know, and honestly the pipeline, you know, while receipt of float interest is good and likely to continue, the sales pipeline that sits in front of us right now is quite mature, and that's where beyond the delivery of the two very large projects and servicing art, really executing on that pipeline now is my main agenda with the business. There's a quick question from John. Karen, if you can see the Q&A, just
I can address that one if you like. Yeah, John, we expect to see a similar amount for the second half of the year. Really, it's spread across the kind of Wrkr platform and that opportunity that we have when we are rolling out to REST customers and Link customers to be able to have Wrkr Ready and Wrkr Pay available and to be able to turn on and off and that be a self-serve. So the development is really part of the projects that we are doing for Hong Kong and Link, and then extended there for that go-to-market opportunity. In 2025, I guess we'll be testing the market to see what they want and what they need in terms of where that further development will be required and what the opportunities are. And also as the Payday Super, same-day super reform, Payday Super reforms come into play and become a little bit closer and a little bit more defined, then we'll also be looking at what we're going to need to do with the product to make sure that we're set for that to go. Hope that answers your question.
And so question. Spot on, Karen. Thank you. Michael, great question. Is there much additional investment required to meet the Hong Kong also requirements? So short answer of that is no, it's not substantive. It's fully funded by Link, and that will be concluded. We will be live in the end of April for May and into May for May and June testing by Link before full production deployment. So it wasn't substantive from our perspective because it was just a build on top of. It was really changed to the portal and the experience layer to the platform and a bit of enhancement to the API. So well underway, small net proportion for our business and a funded piece of work, which again, that was the conversation I was having earlier. We are pushing those costs onto our partners a little, and I think we probably have to consider breaking that approach now as we start to expand a much healthier pipeline. And question from Don. The maturity of the convertible notes note is in September. Will you have the funds to repay, or will you issue shares? So yeah, great question, Don. So at this stage, if I look forward at the cash flows, we will not have the funds to pay back the full amount of the convertible note. However, we do not have an interest in converting them because we think that's too much of a dilution for employers. We are looking at other alternatives to move to really carry that forward over a second term to then be more aligned to our income and cash flow to be able to pay that down. I've signalled fairly strongly I am not pro. I'm a large shareholder, and as many of you are. I'm not pro any dilutionary event unless we can link it directly to growth opportunity. I do think this business would benefit from greater availability of capital. Definitely with the visibility and maturity of the pipeline right now, there's no doubt. However, we can also see a really clear path to continue the approach we're on and drive this business to profitability. The key post that really is moving into FY25, mid FY25 and latter FY25. We can see the full contributions flow coming through from the work done today. That on particular on REST and also with Hong Kong, that's a very healthy position for our business at that point. When I talk about investing or being able to invest, it would be more how we can bring the next 2 to 3 super funds on sooner, because with the full infrastructure built and tested, we can actually bring them on much faster if we're able to manage multiple parties simultaneously, and that contribution matters. So hopefully that answered your question, Don. And John, do you see the change of ownership in Link as positive, negative, or neutral? Yeah, really good question. At this stage, I'm describing it in we're going to get all 3 of those experiences. Short term, there's a few extra decision cycles, and we just felt that with Hong Kong, to be honest. There are some extra layers of approval notification because they're in the middle of a transaction, which, to be honest, they've been in that world for a long time. And so we're used to it. Their management team are diligent and understand that as well. So there's a little bit of extra pain for extra administration, but it hasn't slowed the decisions themselves. We've sort of been moving forward collectively together. So that's probably the only negative element. The positive is really, I think, it removes if this transaction concludes for them, it removes the question about their direction and what they're doing, and that is really healthy for the funds. Obviously, that this deal wouldn't have gone ahead if the funds weren't supportive of it. They clearly were if they were able to go to the next stage in the offer. And the funds want stability here. They want suppliers who are here for the next 10 years to 15 years. So from our perspective, that's really good. Means longer capital investment and actually potentially exposing our tech to a broader global market than just what we're doing with Link in Hong Kong and Australia. But that's the third horizon, and I won't be so cocky as to start putting my eyes out there just yet. I think there is enough opportunity right here in Australia for us. Michael, question from Michael: how long do you imagine the development cycle will be for each potential new super fund post the initial REST float? Yeah, good question again. Very short. To be honest, so they'll just talk about the artifacts so people understand. We have a detailed playbook of how to onboard a fund and the options and decisions, and that was developed in concert with Link over the last 18 months. There will be a build and deployment that's proven, that has been through all of the legal tests around compliance with the SIS Act, which is probably one of the big bits of glue for a super fund. They really can't operate outside what's allowable under the SIS Act. So therefore, a first mover where things are validated and verified is very, very helpful. That we think it will speed up around that type of decision making. The core technology adoption is very fast. The only change is a change to branding for the super fund, and the way we've architected the core platform is it's designed to have what we call one platform with multiple tenants, and each tenant is a brand adoption. So we just simply change the brand and we have a new tenant. They can add more features, they can change workflows and communication, but they are minor implementation steps. So from our perspective, it should be quick. Ideally, if let's say it's a 12-month journey to bring on the first fund, it should be a 6-month journey for the second fund. It should be a 4-month journey after that. I don't think it'll ever get faster because it's a change program as well, and the funds need to participate. You can't just flick a switch behind the scenes. So there's definitely, so that's probably where I alluded to earlier, the importance of having, being able to service and having enough capacity in our team to service 3-4 funds simultaneously will be very important, because it'll never become a flick the switch. Well, there'll always have to be a level of transformational change program to bring them onto the platform and make sure we get 100% of their employer base. Yeah. Hopefully that answers that question. Yes, we're doing well. Smaller group today, probably now those have had more time to digest, and also we have the half year coming up. But if there are any other questions, we'll take a minute or two. I'd happily take them. And if not, I can move to a bit of a wrap up for you. So, yeah, one more question. Is there another Link type provider that you could partner with, either domestically or offshore? Maybe another third horizon related question, but is New Zealand an opportunity? So I'll answer that one backwards for you, Michael. Link are in New Zealand, and New Zealand is certainly an opportunity. We've had discussions there. Helps that our chair is also New Zealand based, so we keep a pretty strong eye on that market. I think it's a good growth horizon, but try to get my eyes. I think adding New Zealand is a sensible thing for any Australian business, but I'd like to see us move towards the UK and Hong Kong as a priority. I think there's larger revenue opportunities there. Link themselves are very active in New Zealand, the UK, Hong Kong, and now starting to grow their activity level in some peripheral areas around Hong Kong, Middle East. So I'll keep the international with them right now, given their potential merge and acquisition for them. That would actually increase substantially anyway through Mitsubishi. So are there other funds? Yes, well, there are a couple in Australia that have a large footprint, obviously Mercer, Iris, Bivera, and then a smaller, more newer entrant in Grow. At this stage, we have a 3-phase approach. We're investing heavily with Link. We're definitely open to working with the other platforms, and we are known to them, which is great. We've out of respect for Link, we've stayed focused on that program first. However, we've increased our activity towards funds directly, particularly funds outside of the Link catchment. Now, those funds may well wind up, that may bring an opportunity towards Link, or it may lead us towards needing to integrate to one of those other platforms. But we're certainly active. In fact, we have, we're in the demo and pitching phase for one at the moment. So we'll continue to push there. But yeah, look, our market is large. If you asked me if I could only stay where we are with Link, I would be very happy, purely because Link has such a concentration of industry funds, and the industry funds are the most attractive super funds to us. We make the same amount of money when we process a transaction for your super, whether you push a trolley and get paid minimum wage, or whether you're the CEO of a large multinational. So for us, we are looking for highest concentration of employees with highest frequency of payments, and they are really the industry funds service that group. So, but yeah, hedging my bets. Sorry, Michael. John, how many weeks, months will rest workers need to trial the products before the final tick is given? Yeah, good question. It's really a testing that it works within their process. So, ideally 1 to 2 pay cycles is what's required. The decision on contributions will happen much faster because once we are implemented and with their branding, there is a transition that is a little easier with the SCH platform of Link. So the core transactions decision will happen faster. The onboarding component, which is those unique features, the mobile experience, there is a need to go through at least 2 pay cycles for that. The employers aren't paying. It's part of the integrated solution for REST. So there's no decision for them other than feedback on does it fit within their processes and enhance their experience. I'll just give an example. We have a live implementation through ART. We know the benefits and impact, so we're fairly bullish about what that decision's likely to be. But that said, we won't put the horse before the cart. We'll make sure we deliver an exceptional experience regardless. And that does take a bit of extra time, and we are all hands on deck. The product team, everybody in the business is helping on the implementation. So we give it what we call the white glove experience. And we think that's more important right now than focusing on anything else. There we go. That's well, I think that is the extent of our questions. So look, a final wrap by a couple of things. Firstly, we have the Investor Hub for Wrkr, which I encourage all of you, if you haven't already registered and connected, you can link to it through our main website. I'll answer any questions, and and we share those publicly. You can remain anonymous, but we make sure that everybody gets to hear those same answers. So and we get some great ones come through. So from that perspective, and any announcements that aren't on the ASX, obviously, are always delivered through that platform, through our website, so you'd see it quickly. Look, final element, how do we feel about the business right now? Really bullish, really proud of the work that the team has done to get it to this state. We intentionally chose to what I call bootstrap, so that's be really cautious on costs. Not so cautious, that we break things. We've been so just cautious rather than frugal. We've been cautious on cost, and that's positioned us very well. I think you can overinvest early and wind up regretting those investment decisions. We don't have any regrets, not for $1. so far. So that positions us very, very well. And now we are moving into this growth phase. It's much harder to sell when there's no anchor client of the new solution that is completely end-to-end. Having a marquee top 10 fund in Australia as a live user end-to-end is a game changer for us because it expedites our sales process. It increases the awareness and then brings more businesses into our funnel. And more importantly, it creates a real competitor in the market that is able to demonstrate benefits using our software, which really narrows then the decision cycle for others. This is a market that tend to take comfort in adopting, although they like to tweak towards their own strategy, but adopting working strategies. So from that perspective, we're really excited. That said, our head is down and tail is up, working on this Hong Kong and rest. They are pretty aggressive timelines, given the workforce that we have available. We're still a 38-person company. So there is, and we have other products, other customers. So we're deploying to Art, deploying to Hong Kong, deploying across all of our direct customers with Click Super, deploying across Rest. We have our direct customers, and we have SMSF Hub. That is a lot for the size business to operate. So we're at 100% capacity, no doubt, but the teams are really bullish and excited. We're not, we can see ourselves pushing through this phase into the new financial year in a very, very strong market position. Ideally, the next conversations for me are very much around, well, how do we accelerate that growth? Because the sooner, this game for us is all about base of customers, so number of end users times the ARPU, the average revenue per user. We've got the feature sets to get maximum ARPU, to get ourselves up between the $7 to $12 per customer. So those products will be built and commercially available post the REST implementation. REST is 1.4 million users. What we really want to be driving is the next 1.4 million, the next 2 million users. Building that base, I'll leave you to do your maths, but that really sets us up to have a very strong core business around super and self-fund our growth beyond. That's the cycle that we sit in. We had always planned for it. We've been working towards it. What has really changed is some of those contracts are now behind us and we're in deployment mode. That makes it more exciting for me. And it certainly makes it real for our business and for our shareholders. So that is why we're bullish on the outlook of the business right now. So thank you all for your time. And if you have any other follow-up questions, remember to connect with us on the hub. Thank you.
Thank you.